For AM Best TV, I'm Diana Dorahy at the 12th Asian Insurance CFO Summit in Hong Kong. And joining me now is Christie Lee, Director of Analytics at AM Best. Christie, great to have you with us.
Hello.
What's your outlook for China's non-life market segment?
The China non-life market segment outlook is negative. However, it doesn't mean that AM Best is going to put a lot of the Chinese non-life companies' rating outlook to negative outlook. It only means that we feel that the current market trend has negative influence on the non-life insurance companies' profitability in the next 12 months.
Many Chinese insurers' profitability is supported by positive investment return. Would this be sustainable?
In the past, because of good investment environment, so insurance company can take these opportunities to grab business growth opportunities by taking marginal underwriting results and get it subsidized by positive investment results. However, for long-term sustainability, insurance companies should focus on improving the underwriting performance because that's their core business.
Substantial assets were allocated to alternative investments like local debt, infrastructure, real estate, etc. What are the market risks and concerns, do you think?
As the interest rate environment has decreased in the last couple of years, insurance companies, in order to maintain stable and positive investment returns, there is a trend on increasing the asset allocation to alternative investment, in particular to loans and receivables type of investment, and some of which are in support of Belt and Road infrastructure projects or real estate projects. Our view is that because of the longer duration and the lower level of transparency of underlying risks, we feel that there is increasing credit risk as well as potentials of liquidity and asset liability mismatch.
Amid some of the regulatory changes, how would this affect China's insurance landscape?
The new regulator direction is going to be increase the bar on corporate governance, on capital level, and also like on data accuracy, all this for sure. So, but there is still uncertainty about how C-ROSS Phase 2 is going to play out in the next 3 years. But it's certainly going to increase the requirement and going to increase the cost of compliance, complying with the regulations. In particular, it will add additional management expenses pressures to smaller insurance companies.
Do you think the industry is well prepared for those additional costs?
I think the smaller ones, they are suffering from this, in addition to the intense competitions, which leads to higher commission costs and also really competitive environment for lower underwriting profit. So overall, I think the large insurance companies are pretty stable, but the small to medium companies, they are suffering from underwriting losses.
Christie Lee, many thanks for your insights.
Thank you.
For AM Best TV, I'm Diana Dorahy at the 12th Asian Insurance CFO Summit in Hong Kong.